If you're a maintenance supervisor at a manufacturing facility and your machinery isn't working right, Grainger knows you need to understand what's wrong as soon as possible. So when a conveyor motor falters, Grainger offers diagnostic tools like calibration kits and multimeters to help you identify and fix the problem. With Grainger, you can be confident you have everything you need to keep your facility running smoothly. Call 1-800-GRAINGER, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
What investment styles suit you? Good morning. This is Jon Heischman. Let's talk about that as I bring you the Safe Money and Retirement Show. We are approaching the last quarter of the year, which is a great time to do an investment review with your advisor. Consider the investment styles that best suit your personality and goals. Assessing your preferences by each style can help you determine which styles best suit your personality and comfort level. Every investor is different, so we have to look at what appeals to you. Active investment is buying and selling investments based on their short-term performance, attempting to beat the average market returns. Passive investment is buying and holding investments with minimal portfolio turnover. So we see active managers generally measure their success by determining how much their portfolios exceed, or I should say, fail to match, the performance of a comparable unmanaged index, industry, or market sector. They also assess portfolio risk and how successfully they achieve other portfolio goals. I think this distinction is important for retired investors who need to manage risk over shorter time horizons. Active management. Now, this may appeal more to investors who prefer to hold individual securities. Passive investors rarely trade individual securities. They prefer to hold investments over a long period of time, or maybe to purchase mutual or exchange-traded investments. Passive investors tend to rely on fund managers to ensure the fund investments are performing exactly how they expect managers to replace declining holdings as needed. And this may sound a little technical, but the point is your investment portfolio. How is it managed? Because passively managed funds, they're generally going to have lower fees and more tax efficient than actively managed funds. With active investing, you pay for the sustained efforts of professional investments managers. They're going to specialize in active investing and for the potential for higher returns than the markets. Investors considering active management should take a look at after-fee returns. I don't want you to be confused. But again, we have to make sure these investments are right for you. So if you're questioning if your investments and retirement accounts are right for you, I can give you a second opinion, and it might be right for you. It might not be right for you, but I think it's important to know. I'm going to give you a number to call. You'll leave a message. That message will be forwarded to me to follow up and talk to you about your investments. 888-426-0177. That number again is 888-426-0177. Our firm, and I say our firm because it consists of myself and my son, are independent advisors and planners. My son is the investment specialist with over 20 years experience, and I think he's very knowledgeable and easy to work with, and also manages my investments and honestly has done a very good job. So the message you can leave when you call is interested in investment review. 888-426-0177. Do you want growth or value? Are you more comfortable investing in fast-growing firms or underpriced industry leaders? Growth investors, they're going to seek companies with high earning growth rates, high return on equity, high profit margins, and low dividend yields. The basic tenet is that a firm with these characteristics, it's often an innovator. Growth companies generally reinvest most or all of their earnings to potentially sustain continued growth in the future. We see value-style investors focus on buying strong companies at reasonable prices. They'll look for low price to earnings ratio, low price to assets ratio, and generally higher dividend yields. And this style, it's focused on the price at which investors buy. So we get into small cap or large cap. You need to know how risk adverse you are, because your answer will determine your market capitalization style. Market capitalization is the number of outstanding shares of stock multiplied by the share price. Now, small cap investors believe smaller companies should deliver better returns. Why? Because they have greater growth opportunities and are more agile. But it's important for the investor to know that this potential comes with greater risk. Smaller companies have fewer resources and often less diversified business lines. Share prices can fluctuate more widely. Now, this will generate significant gains or losses. Small cap investors, they must be comfortable taking on this additional risk for potentially greater returns. And a lot has to do with age and how close you are to retirement, because what we see from our clients, their risk tolerance has a tendency to change as they approach retirement and while they're in retirement. We want them to have growth with an emphasis on preservation to keep what they've built up over the years because of income lasting through retirement. So if you're more risk adverse, you may be more comfortable investing in large cap stocks. These are companies that are more established in their industry and have been around for a while. They may be unable to grow as quickly as smaller firms, but they also are more likely to go out of the business they're in without any warning. So, in return for the potentially lower risk, expect slightly lower returns with large cap stocks. Every retiree, your investment style is unique and may not be exactly one or another. You must have a trusted advisor that's going to help you mesh your personal styles and investment choices. You need to be aware of advisor buying and selling with your approval on all transactions. Visit our website, HeischmanFS.com. I'll spell that for you. HeischmanFS.com. If your advisor has retired or is no longer in practice, I think it's imperative that you have someone to work with, manage your investments with constant contact. You don't want to have a 1-800 number to call corporate. I refer to this as a house account, which we see many times because maybe your account is too small. Or, as I said, your advisor may have left the business. So it doesn't matter how large, how small your investments are, you need an advisor. 888-426-0177. We'd like to hear from you. That number again is 888-426-0177. It's time for a short break, so stay tuned. I'll be right back.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
The goals of good retirement planning are to help each individual to end up with more money at the end of the day, but also provide more income during retirement. And this creates a less stressful investment experience, especially in times like this. I like to emphasize and stress stronger financial understanding. Not only could you have greater wealth, more income, and a better night's sleep, you should also have a stronger grasp of your own financial standing. With a strong retirement plan in place, you're going to know exactly what you can withdraw from your retirement accounts every month, how much you need to live comfortably, and how long your savings is going to last. This is Jon Heischman, your host with the Safe Money and Retirement Show, 888-426-0177, 888-426-0177.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
Welcome back to the Safe Money and Retirement Show. I'm your host, Jon Heischman. As a follow-up to the first part of my show this morning about investments, we need to define your attitude about risk. When you were in your 30s and 40s, it was easy to have a cavalier attitude about what the stock market was doing.
You just realized your business needed to hire someone yesterday. How can you find amazing candidates fast? Easy. Just use Indeed. Stop struggling to get your job post seen on other job sites. With Indeed sponsored jobs, your post jumps to the top of the page for your relevant candidates, so you can reach the people you want faster. According to Indeed data, sponsored jobs posted directly on Indeed have 45% more applications than non-sponsored jobs. Don't wait any longer. Speed up your hiring right now with Indeed. And listeners of this show will get a $75 sponsored job credit to get your jobs more visibility at Indeed.com/PODKATZ13. Just go to Indeed.com/PODKATZ13 right now and support our show by saying you heard about Indeed on this podcast. Terms and conditions apply. Hiring? Indeed is all you need.
And you actually had two things on your side. You had time and a steady income from employment. You had the time for the market to recover, and you could ride out the ups and downs. It is possible as you near retirement, you no longer have the luxury of time. It's not feasible for you to wait for the economy to bounce back or the stock market to right itself. For example, if you experience a market loss of 20%, you might have to learn to live on the 20% less income for the future. And I'm referring to a loss of 20% in retirement. Prior to retirement, you didn't have to worry about it because you had plenty of time to bounce back. And the problem is, what a lot of people don't realize, that in order to recoup the loss of 20%, you actually need a 25% gain. Let me give you an example. Let's say you had 100,000 and you lost 20%. Your new balance is going to be $80,000. If that account grew in the following year by 20%, the account balance would be $96,000. In the previous years, you had a regular income stream from employment. And if the need arose, you could set an additional amount aside to help get your savings back on track. Working full-time, earning an income that you could depend on, most people will have a totally different attitude about losing that 20% because it didn't affect their potential income. Your biggest producing income asset was yourself. And once that producing asset stops producing income, your other assets are too important to leave to chance. Most retirees are going to need that asset or assets to produce income during retirement. And I think obviously everybody realizes that during retirement, the paycheck stops and your Social Security income begins. Any additional income that will be needed needs to be created by you as a retiree. You can either create a new stream of structured income from the assets you've accumulated or from your retirement accounts. But this can be more complicated than most retirees realize. Every year, those accounts undergo changes. The market has gone up or gone down, or for some amount of interest has been credited, but you don't know from year to year. For some accounts, fees will be taken out to cover expenses and riders. So as a retiree examines their statements, they need to decide how much to withdraw to maintain their standard of living for the upcoming year, factoring in taxes and inflation and increased healthcare cost. Improvised income. It can be quite dangerous in retirement, whether the market is up or down. You will still need income every year. In a down market, these systematic withdrawals very possibly could exhaust your retirement assets more quickly than anticipated. And designing retirement income plans, I see clients feel much more secure when there is structured income that will create an income for the rest of their life, which is guaranteed. The ups and downs of the market will not affect and has no bearing on this lifetime guaranteed income. So I want you to give thought to your planning. Is there sources of guaranteed income on and above Social Security or a pension? Because typically a retiree is going to need more than what Social Security and a pension will provide. And after you have thought about and taken a look at what sources of guaranteed income you have, if any, I want you to call me because I have the solution on how to structure income during retirement that's going to be guaranteed for the rest of your retirement. 888-426-0177. Again, 888-426-0177. What we want to do is create a product that specifically addresses these needs and have a proven track record to provide that guaranteed lifetime income and give you growth, structured income, lifetime income, and a lump sum benefit payable to your beneficiary upon death. There are a variety of tools that are designed to do specific things for each retiree. For example, life insurance pays a lump sum amount to beneficiaries. Checking accounts are used to pay bills and manage short-term cash. Health insurance pays medical bills, and liquidity options help to prevent taking money out of retirement accounts. And what I have been discussing, plans specifically designed to create guaranteed income. And that income can be immediately upon retirement or delayed to a specific time in the future. If income is delayed, each year that it is delayed, it will increase, which I refer to as a roll-up. As you begin your retirement, or maybe you're 5 years away from retirement or even more, some form of guaranteed lifetime income needs to be considered. Potential growth prior to taking income and during income payouts could increase your value as well as protecting you from any market risk. Any gains are locked in prior to and during the income payout period, which that period is for the rest of your life. The great thing is today you can manage your lifestyle, avoid market volatility, and create that lifetime income by doing some planning. Address the possible changes in retirement and financially survive, even thrive during retirement. The majority of retirees and retirement plans will include some form of guaranteed lifetime income. So you need to find out as much as you can prior to retirement, or even if you're in retirement now. I want to give you the number to call again so I can provide you with more information, educate you on guaranteed sources of income. 888-426-0177. I offer a really good brochure that you can request. I can send it to you by regular mail or an email attachment. 888-426-0177 to request your copy. I appreciate you taking the time to listen to the Safe Money and Retirement Show, and be sure to tune in next week for more ideas that will help you have a more secure retirement.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.